Good morning. This is Curt Thompson, and thank you for participating in today's webcast regarding two new alternative strategies that we are recommending for client accounts that Nick and Matt will review in more detail. I know some of you are still registering. We've committed 30 minutes for this webcast, and we appreciate people's time to participate in this. Started right away. These two new strategies are open to accredited investors, and there are both taxable and fiduciary clients Webcast. And I know for our taxable clients that have many different types of accounts, including for children and grandkids trusts, required to provide information on the eligibility of both of these strategies. So we can talk to you in detail about this. We wanted to show you this one slide. Once again, both of these are open to what we call accredited investors. And on the page, we've outlined what that means. In essence, per SEC rules, it means you have to have earned income of at least $200,000 individually or $300,000 jointly in the prior 2 years, or the portfolio has to have a net worth of $1 million, excluding a primary residence. And once again, for those of you taxable clients on this webcast, we can work with you determine the eligibility of various accounts that you have that might be outside of the primary trust account or LLC. So as we talked about in our webcast on the 14th, just 2 weeks ago, we're living in a very, very low return environment for traditional safe assets, in this case, fixed income and US equities. So this chart, which once again, we show to you every quarter, outlines our forward 5+ year annualized expected returns from various asset classes. And once again, this is a collaboration of many of our firm's open source investment partners, the world's leading investment organizations, their individual capital market assumptions, and then one we calculate internally, and we meld them together. But universally, the whole market expects very low returns coming from traditional core fixed income, which is muni bonds for our taxable clients, and US core bonds for our fiduciary accounts. So somewhere between 1% and 2% returns. And then as we look to the right, the blue bars, US large cap, given the big run in equity and extended valuations, is likely to produce less than a 5% return. We still believe returns will be better out of foreign markets simply because they're not as valued as richly as the US market. Those markets have not participated in the rally as much over the last 12 years as US stocks. But if we combine US and non-US markets collectively, under the global equity column, I think we're going to be around 6%. So less than 2% fixed income and around 6% for global equities. For those of you who have spending policies of 5-6%, it's a very challenging environment. And so therefore, our firm has been spending more of its time focused on opportunities on the 3 bars to the right: private assets, private credit, and private equity. Many of you are participating in the recent private real assets portfolio, the Blackstone BREIT, which was funded at the very end of December. And today, we're going to take time to talk about a private credit and a private equity strategy. So I'm going to turn the presentation over to Nick and Matt, who'll go through in detail each of these opportunities.
Thanks, Curt. So prior to discussing the 2 opportunities, I just wanted to review our private market approach. We allocate private market into 3 sub-asset classes. The first one being private equity, which traditionally falls into primaries, secondaries, and co-investments. Today, the private equity vehicle we're going to discuss focuses primarily on co-investments. In private credit, typically it's investment grade, distressed corporates, as well as alternative exposures. Today, the private credit portfolio we're going to discuss focuses primarily on alternative exposures. And then real assets, which traditionally includes real estate, infrastructure, commodities. We don't have a vehicle to discuss today, but as Curt mentioned, we talked about Blackstone BREIT last quarter, and that portfolio is continuously open to new investments. So looking at our first investment, it's the AMG Pantheon Fund, which falls into our private equity co-investment category. Co-investments are minority investments that typically happen alongside a private equity firm into a single portfolio company. So you're not investing in a private equity fund that invests in multiple portfolio companies. This is more of a sidecar investment that you would invest in directly into a single portfolio company alongside a private equity manager. The benefit to these are you get kind of this primary private equity exposure without the usual high fees, and we'll provide more detail on that. This fund is somewhat unique for private equity because it's an evergreen, continuously open for investors fund. Typically, private equity has a window of time where it opens for capital, and then it closes, and then it invests the capital and it harvests the gains. This portfolio is expected to remain continuously open so that investors can change their allocation or invest more dollars over time, should that make sense. The portfolio size is 270 million, which at first glance might seem small, but this vehicle was created primarily for high net worth and institutions that didn't want to write the big tickets that that the other Pantheon funds require. So this vehicle is specific for smaller commitments, and it invests alongside Pantheon's firm other vehicles. They have other co-investment, secondary vehicles, and primary vehicles. The investments in this portfolio are similar to those. So the total co-investments is 4 billion, even though this portfolio holds about 200 million. So when we look at private equity, it has characteristics that make it attractive in a global balanced portfolio. The first one is the historic outperformance versus global equities. If you look at the chart on the right, it shows annual performance of about 4% to 6% per year versus global equities over shorter time periods, called 5 years and 10 years, and even over the longer time periods of 25 years. In addition, private equity tends to be less efficient market than public equities since it doesn't trade on public exchanges, which helps improve portfolio diversification. Now that we discussed some of the benefits of private equity, I want to review some of the traditional challenges of private equity that have possibly kept some people from investing in them. On the right side, I'm going to discuss why Pantheon has kind of improved on some of those traditional challenges and has mitigated a lot of those. So just looking at the challenges first, we look at the J curve, which means basically that in the early years, negative returns, which come from the long lockups of 8 to 15 years in the portfolio. So private equity firms, they invest in these portfolio companies that aren't really generating returns yet. There's a lot of costs that are experienced in the first few years. So your return tends to be negative for those first 4 to 5 years before you start seeing returns out of those portfolio companies. It takes about 3 to 5 years to build up a full diversification of portfolios in these funds. And over that time, you have what we call blind pool risk. It's a lack of transparency into the future holdings that private equity firm is actually going to invest in. So as I mentioned, you think Pantheon has approved a lot of this. They try to break the mold of kind of the traditional private equity challenges. So the AMG Pantheon fund provides an immediate, fully established, diversified allocation with full transparency into the underlying portfolio companies. And in addition, we're going to discuss this in detail, the lockup of your capital is greatly reduced from what a primary fund typically has. On slide 9, I'm going to spend some time providing some information on the firm and also the fund. So Pantheon is one of the most well-respected private equity firms in the market. They have a 35+ year experience and a strong track record in private markets. They manage today roughly $50 billion in assets. I mentioned 4 billion of that is specifically in co-investments. That relationship between the 50 and 4 is not surprising because co-investments tends to be kind of the smaller side of what private equity managers invest in. Primaries tend to be the largest pool of assets, secondaries the second biggest pool, and co-investments are typically the smaller pool. They have over 100 investment professionals that are spread out across the globe, as this portfolio and all their portfolios are global focused. The fund itself is very unique for private equity. It has monthly subscriptions, quarterly redemptions, and it has a 1099 tax structure, which again is another benefit which traditionally private equity comes with K1s. As I mentioned, the portfolio is already established. It focuses on co-investments, and it has a strong performance track record. So for the second half of AMG Pantheon, I'm going to turn it over to Matt to go through some of these in more detail.
Great, thanks, Nick. So one of the key selection criteria for the Pantheon strategy was its ability to generate robust returns with downside protection during times of stress in public equity. So on the left-hand side, we see that Pantheon has kept up with global equities run since inception, but it has achieved that at 60% less volatility. So while our forward-looking expectations on public equities will be muted going forward, around that 6% range that Curt mentioned earlier for global equities, the Pantheon fund is expected to generate returns closer to the historical average. We can look at the downside protection on the right-hand side of the page here with the Pantheon fund's actual outperformance in public market downdrafts over the last 5 years. So just to call out a recent example, on the far right, global equity was down over 13% for the month of March on a total return basis. Pantheon fund was down only 1.4%, essentially a 90% lower drawdown compared to public markets. So a core feature of Pantheon's strategy is their focus on co-investments, as Nick said, and also secondaries. The largest allocation of the fund is derived from co-investments, which are an efficient way to get direct exposure to operating companies alongside a private equity fund. These co-investments are the same ones executed on by Pantheon's $3.9 billion of core institutional direct mandates, and they're actually the benefits of Pantheon's longstanding relationships in the marketplace and their positions on advisory boards. The second core allocation is in secondaries, which are existing private equity funds that are acquired through privately negotiated transactions. One of the benefits of that is they're actually acquired on a discount, and they're after the end of a private equity fund's fundraising period. So they're already close to the distribution phase. So since we have the benefit of them being further along in their life cycle, this mitigates the classic J-curve effect of regular primary private equity investments by purchasing the fund interests that are already in the distribution phase and have their money already in the ground. So Pantheon sources this sleeve from its $13 billion secondaries business for institutional investors. And finally, there's a sliver of primary funds that are diversified across vintage year, sectors, and geography. They have larger return potentials over longer horizons, and they help diversify the other two allocations. So these three core components represent a complete and diversified private equity exposure in one fund. Now, you may ask, how diversified? Well, the fund has broad coverage across industry sectors with different macroeconomic sensitivities, and this provides ballast across the business cycle. In addition, the fund is diversified across vintages, owning interests that span across 13 vintage years. This ensures a diversity opportunity set of acquiring operating assets across the last couple of business cycles. The fund has a global opportunity set and holds around 70% of the allocation inside North America and covers the various stages of private equity, such as buyout, growth, and special situations and others. Now, with that, let's go into some of the specifics about the fund structure, expenses, and the implementation on our end as investors in the fund. So first, the fund issues a Form 1099, as Nick said, so no K1 hassles with our high net worth clients for this strategy. The fund is a non-traded private equity vehicle. It's evergreen, meaning that it'll continue to allow additional investments to the fund over time. The Pantheon fund has quarterly liquidity for redemptions, and the recommended amount is up to 5% of the fund's net asset value. But it can be higher than that 5% with board approval. I do have to say that the quarterly liquidity privileges are not guaranteed, and they are also subject to board approval. In addition, for the first year of investment, there's what's called a soft lock to get your capital out, where there's a 2% repurchase fee in place. After the first year, there's no more repurchase fee, and this is essentially to protect the remaining investors in the fund of capital coming in and out too quickly, with these illiquid assets. So the fund has a management fee of 1.45% per year, with other internal expenses such as acquired fund fees and administrative costs adding another 1.16%. We expect this portion to decrease as the fund grows due to increased scale, and there's no carry or performance incentive fee for this fund. The fund strikes a net asset value every month and also allows subscriptions on a monthly basis as well. These subscription forms can be docu-signed, and net asset values are released around 20 days after month end. There's a $50,000 minimum initial investment for this fund, and it is restricted to accredited investors only, as Curt said earlier. So this wraps up our feature of the AMG Pantheon Fund. Now we get the chance to jump from private equity to private credit markets for our next strategy overview.
So the second investment we're going to discuss is the Variant Alternative Income Fund, which falls into the private credit allocation. This is another evergreen, continuously offered fund. It is diversified alternative private credit exposure with a history of strong cash flows and low correlations to public assets. The portfolio today sits about $640 million. It's already established allocation, 72 positions in 11 unique asset classes. Again, looking at the firm and the fund in a little more detail, Variant is a niche credit opportunity specialist. The team that manages this portfolio has 15 plus years working together on these types of strategies, and the entire firm just focuses on this one single fund, where traditionally bigger firms might have several different vehicles going on at one time, and one investment team may actually do investments for multiple of those portfolios. Here we just have a single focus fund that the team manages. They have a very innovative structure. It is called a closed-end mutual fund structure. So this fund actually has a ticker, and it has daily pricing that you can follow online. So a unique feature of private markets. When looking at the portfolio, this one also has quarterly liquidity. It has a 1099 tax structure, again, avoiding kind of the K1 difficulties. And performance has been very strong and consistent while providing significant downside protection versus public fixed income, which we'll cover in subsequent slides. Looking at performance on slide 17, so the fund's been open since late 2017, and it's produced positive returns in 37 out of 39 months. The 2 down months have been very minimal. It's been able to produce 8% inception to date annualized returns, which is very attractive for private credit, and also something we're considering to replace traditional fixed income, which is coming at much lower returns, as Curt mentioned earlier. I just want to call out the 2017 number. The portfolio is up less than 1%. I mean, this is typically expected in a portfolio when it first opens. It only opened in October 2017, so it was only open for a few months. So, initially all those investments are being made. The portfolio, wasn't probably well diversified at that time. So we're not too concerned about that 2017 number. Looking at 2018, we look in a little more detail about how, this portfolio can, improve portfolio return, but also improve, what we believe will be the realized risk of the portfolio. So the chart on the right plots Variant in white relative to investment grade bonds, high yield, and hedge funds. Typically, areas where we would source the funds to invest in Variant. And when you read this chart, it plots risk and return, and you really want to be in that top left quadrant. That's the most attractive place to be, because in that area, you're providing the most return with the lowest risk, and that's where Variant resides. They've been able to provide a 6% annual distribution rate. Again, that comes out quarterly, and that distribution rate is about 4 percentage points above traditional investment grade bonds.
So the Variant Alternative Income Fund has delivered consistent returns with about a 50% risk savings versus investment grade corporate bonds. You see that the volatility number of Variant at 1.6% versus 3.3% for investment grade corporates. Again, we see that we have the opportunity to highlight some of the most difficult times for credit fixed income investors over the last few years on the chart on the page. We again see that March 2020 offers an example of the downside protection of this strategy compared to other fixed income asset classes. With the fund only down 0.5%, that's actually its worst month of performance, compared with other credit bonds, which were down between 6 and 10% for the month of March. Another key differentiator is that Variant actually lowers overall portfolio risk due to its low correlations to traditional fixed income and essentially zero correlation to public equities. So it's shown itself to produce notable absolute returns driven by income and better risk-adjusted returns for the whole portfolio when taken in a broad portfolio context. So the key to Variant's consistency is the diverse subset of uncorrelated niche strategies that generate unique sources of significant accrual income. So these are smaller and inefficient subsectors of private markets that require a significant amount of due diligence, expertise to source and monitor. So many of these sectors represent various types of senior credit facilities from non-bank private lenders, such as specialty finance, litigation finance, and trade finance. So deals for the underlying managers are often individually negotiated, and they have extra protections in place to have the issuer bear some of the first losses or implement an insurance policy payout in a credit event or default. So there's a lot of security that's built into the structure of these deals. The fund is also globally diversified. So just from an allocation perspective, we're looking from not only a bottom-up individual deal risk management process, but a top-down risk management process as well. Now, the Variant Alternative Income Fund is the diversified private credit alternatives fund, structured as an interval closed-end fund, meaning it's continually offered and can be purchased daily. You can actually track it with ticker NICHX or NICHX. It pays income quarterly, as Nick said, and it has redemptions on once a quarter as well. Now, one differentiator is the liquidity privilege for this fund is mandated by the Investment Advisors Act of 1940. So there will be continued liquidity privileges that will be no less than 5% of the fund's shares outstanding. So if redemptions exceed 5%, the repurchase will occur on a pro rata basis, which essentially means that that shareholders will not have all of their tendered shares repurchased by the fund in that quarter. They may have to request in the subsequent quarter. So the net expense ratio is 2.23%, and that includes all the various types of fees, including management fees, administrative fees, and acquired fund fees. We expect this to reduce marginally over time with benefits of scale, particularly the administrative fee side. And again, there's no carry or performance incentive fee for this fund. We're targeting a minimum investment of $25,000 for this fund, and it's restricted again to accredited investors only. We don't need documents signed to purchase this for client accounts. However, as fiduciary, we'll look to get a personal confirmation of intent to invest in the strategy through email or verbal approval from you folks. So that's just to make sure that everybody's fully comfortable with the implementation of this fund.
So as we look at we introduced at our webcast on the 14th, this is the new structure that we're moving to as a firm. We have three structured buckets: a fixed income bucket, a public equity bucket, and a private bucket. As noted on this, the AG Pantheon, we are targeting to be 50% of our clients' private equity allocation. Once again, that's customized event. In this particular page, we're using an example of a 70% and 30% fixed income. The next open date for the Pantheon vehicle is March 1st. So in this case, we will be producing paperwork that can be signed. It is a limited partnership. So Dan Chess in our office will be sending the documents electronically to be endorsed. And that would be sourced from additional equities, which would be balanced. For our taxable clients on this webcast, as you recall, we did a significant amount of tax loss in accounts at the end of March and the first week of 2020 when the market declined. And we repositioned portfolios into different ETFs that allowed us to capture that loss into market exposure. So most of our taxable clients are still in a short-term gain. Once again, if we rebalanced out of that, trigger short-term loss, short-term gains, and which we very much want to avoid. So for our tax clients, we'll likely delay implementation of this until we can move those securities to a long-term gain. Once again, that's going to be at the very end of March or the first week of April. And then for our fiduciary clients or IRAs, we can make that on March 1st. Variant is a little bit easier. As I mentioned, actually a traded closed-end mutual fund with daily pricing. So we pay, and our opinion is to 40% of the target private allocation into that vehicle pretty quickly. In this case, not a limit because it's a closed-end interval fund. We have the authority to put it in, but we're going to send emails to all the clients with our specific recommendation and dollar amount. So with that, I'm going to end the webcast. Once again, we'll be in touch with all of you individually. And we think these are two great and exciting strategies for the portfolio that we think will improve returns and reduce risk. So we'll be following up with you shortly. As always, if you have any questions, you can reach out to Nick or Matt about these investment opportunities. And thanks so much for your time today, and we look forward to being in touch shortly.